The May WASDE was quite a market mover on Tuesday as we got numbers for the first new crop baseline, which came in relatively supportive for most crops. Expected corn production is lower this year by 6% due to less acres. Soybean production was increased, however, ending stocks were decreased because of stronger expected crush demand. Cotton supply got both a lower expected production as well as higher demand, which was quite exciting for that market. And then, of course, the most excitement we saw with this report was the wheat numbers. All of this led to a rally in prices of both grain and oilseeds, with December corn sitting a touch above $5 now, November soybeans managing to break the $12 mark, and KC wheat shooting above $7. Let's break down the driving forces behind these moves. The wheat complex undoubtedly delivered the biggest fireworks. The USDA dropped the national wheat yield to 47.5 bushels per acre, cutting year-over-year production by more than 400 million bushels. There's a lot of talk from farmers of crop abandonment as well, which is beyond what these numbers show. The spring has been a really big challenge for farmers as hot and dry weather struck a good portion of winter wheat area, and we've also seen some late frosts across the plains and western portions of the US. Both of those combined, of course, has led to some stunted growth as well as lowered yield potentials. On top of that, of course, we saw a lot of acreage shift away from wheat after last year's severely depressed prices left most producers deep in the red with margins. We also saw a large shift away from spring wheat acres as well, as a lot of farmers found profitability to favor other crops such as corn. On the soybean side, the balance sheet got a pretty friendly boost domestically. The USDA tacked on an additional 120 million bushels on crush demand, confirming the multi-year highs that we've recently seen in soybean oil and underscoring that robust domestic demand that's been a pretty hot topic recently. With US beans running roughly $1 above Brazilian offers, our domestic consumption has really become the absolute lifeline for US growers. However, that being said, while there's a lot of pressure there are some bright spots with the biofuel market and also potentially adding some additional demand there. Additionally, we're seeing headlines now that President Trump has arrived in China today and will be continuing talks with their president, which could further potentially boost soybean prices as some of those headlines lead to potential demand in the future. But let's look past the raw data and read between the lines. Are the USDA's baseline assumptions truly realistic right now? As I mentioned earlier, conversations with farmers across the country lead to the possibility that USDA's cuts might not capture the full scope of the disaster in the plains. Local wheat tours are also indicating that we might see US stocks drop even further than what the USDA is currently indicating. That being said, the global balance sheet still remains relatively healthy, and the US isn't the dominant player in world wheat exports. Funds are aggressively buying back into the market right now, which is helping out these prices, but we have to ask if domestic tightness alone can sustain a massive long-term run without a broader global supply hiccup. Weather is also causing challenges for other crops such as corn, where drought of course is affecting the western corn belt, and heavy rains have caused some replant issues in the central belt as well. For now, I think a majority of corn country has had a pretty decent planting weather, but it's still something to keep an eye on as we move forward. There is some speculation that the initial USDA planted corn number could decrease due to nitrogen prices. I will say from my conversations with farmers, I mostly received the sentiment that corn still penciled better for a majority of producers, and there's also a stronger conviction that you can out-yield the market with corn compared to other crops. Also, historically speaking, the USDA does typically show an increase in final acres for corn compared to intentions, but of course, still something we'll be watching closely. I think it could go either way as of now, but there's definitely some concerns with how expensive fertilizer prices did rally this spring. In relation to that fertilizer issue, yields could also be pressured lower, as well as some producers potentially pulled back on fertilizing due to those higher costs. And then on top of that, we do have to keep an eye on some of those replant acres and how that affects things going forward. This brings us to the most critical takeaway for your operation: harvest the rally and trade reality, not greed. If the last couple of years have taught us anything, it's that profitable marketing windows don't stay open indefinitely. Take a hard look at your break-evens and use these rallies as strategic opportunities to manage risk. Lock in your worst case scenarios, set floors using options, and of course utilize tools offered through your elevators and delivery points like minimum price contracts. That is going to allow you to incrementally reward this market. If setting a profitable floor ends up being your lowest price of the season, that's a fantastic problem to have. Don't let greed leave your downside exposed. Respect the rally, execute good business, and live to play another day. If you found this breakdown helpful, make sure to hit the like button, subscribe for more deep dive ag market analysis and commentary, and let us know in the comments. Are you aggressively locking in these prices now and taking advantage of these opportunities, or are you holding out for more weather premium? Thanks for tuning in, and I hope everyone has a safe planting out there.